Time for our ETF Spotlight. Mike Santoli today taking a look at bonds versus stocks over the past year. Quite the move we saw in bonds today, Mike.
Yeah, Sarah, been happening for a while today, just extending that bullish move in bonds, obviously lower in yields. And obviously, it's been the story for about a year, and we're neck and neck here if you look at just the price return of some big stock and bond ETFs. So here is the AG. That's the total U.S. bond market aggregate index, treasuries, mortgages, corporates, all of it in there. Here's the investment-grade corporate ETF, LQD, against the S&P 500 ETF display. You see here that on a one-year basis, the S&P still holds a slight advantage. However, if you're talking stocks versus bonds, you have to look at total return, which includes interest and dividend payments. And on this basis, for the AG, you have 6% on a one-year basis because of that income. The LQD plus 7.8%. And you have about plus 6% on the S&P. So there you go. Bonds have beaten stocks on a total return basis on a one-year basis. And by the way, with a much smoother ride. Look at here. This has been your move in stocks. So obviously, bonds are doing their job as a stabilizer of portfolios. We also do have a one-month look, which does, of course, show that bonds have been the haven here, and the S&P has suffered a bit. Obviously, doesn't mean it's forward going. It doesn't mean this is the way it's going to stay. But clearly, bonds in favor and all the bond-like parts of the stock market holding up the index as well, guys.
Anything to think, Mike, that would change? Or does the trend just look set to persist as things like the U.S.-China trade fight get prolonged?
You know, Sarah, it's hard to know exactly how much more price appreciation you're likely to see in treasuries or how much more corporate bond spreads would compress from here, given the uncertainty about the economy and the global growth picture. So it's not necessarily the case that you'd say, OK, we should just bet on this trend continuing or accelerating from here. And of course, the stock market had a great run before this one-year window that we're looking at. So I don't know that you'd necessarily say right now is going to be an inflection point in one direction or the other. But clearly, the bond market is lobbying hard implicitly for a Fed rate cut. If we don't get that, what happens to yields down the road? Because that would probably mean the economy were better.